With the recent blow-up of SVB and concerns at other banks, you may be wondering, what about insurance on my brokerage account? That's a very logical question. That's what we're going to be covering in this video. The topics we'll cover are what the SIPC covers at your broker, and the SIPC is the agency that makes that coverage for you. We'll talk more about that. And then what the SIPC doesn't cover. Then we'll also talk about how multiple accounts are handled. So if you have more than one account at one brokerage firm, how do those limits work? And then we'll talk about who is the SIPC. A lot of people think that the SIPC is a government agency. It's not. And we'll also talk about how long it takes to get recovered from the SIPC, how long it takes them to replace your securities if they're lost, or how long it takes them to pay you back money if you're covered and you have a loss. So that's what we'll be covering in this video. What exactly does the SIPC cover? The SIPC covers securities that you have at your brokerage firm. Examples of what they cover are things like stocks, bonds, as well as CDs. They even cover options contracts like puts and calls. So if a stock that you own disappears or gets lost from your brokerage account, the SIPC is the insurance that would handle that. If for some reason the securities can't be replaced, the SIPC will pay you the value or the worth of that security at the time that you file the claim. What the SIPC does not cover. The SIPC will not cover losses that you have from bad advice that you receive from a broker. So that's sort of a bummer because sometimes that happens. And they will also not cover a loss in the value of your security. So say that you bought a stock in a company and that company went down or maybe went completely under. The SIPC will not cover that. They only cover when securities are lost or something happens, they go missing at your brokerage account. So just how much is the SIPC coverage? The coverage is $500,000 or $500,000, and that includes $250,000 coverage for cash. Now, it gets a little bit tricky because you have more coverage than it sounds like if you have multiple accounts at one broker. The amount of coverage that you have depends on the way that the accounts are structured. This is called a separate capacity. So that would be like an IRA versus an individual account. So we'll look at this. Now you can take a look at the SIPC website to see exactly what a separate capacity is. For example, you can see from this list that separate capacities are individual accounts versus a joint account. So if it was just me versus me and my husband, those would be considered separate capacities. And then an account for a corporation is yet another capacity. So if you have a small business like I do, and you have an entity like an LLC or some sort of company that your business operates under, then that would be yet another capacity. And then an account for a trust that's created under state law is another capacity. An individual retirement account, so IRAs, and then separate from that is a Roth individual retirement account. So each type of IRA is considered a separate capacity in coming up with these insurance limits. And then an account held by an executor for an estate is yet another separate capacity, and an account held by a guardian for a ward or a minor. So if you had an account that you were holding for your child, you were the guardian, then that would be yet another separate capacity. So there are a lot of ways that you could end up with coverage way more than $500,000 if you had an individual account, a joint account with your spouse, a couple of different IRAs, a Roth and a traditional IRA, for example, then you could see that your coverage could easily and quickly add up to $2 million, and that cash coverage would also apply to each of those separate capacities. You can take a look at this. I'll put a link in the description so you can look at the SIPC website if you would like. Also keep in mind that SIPC coverage is per broker. So if you had multiple accounts at multiple brokers, you could have even more insurance coverage than it seems like you would have initially. Most, but not all brokers have insurance coverage, and you can actually go to the SIPC website. It's really easy to just one click and look and see if your broker or any broker you're considering using has SIPC insurance coverage. So what is excess SIPC coverage? You may have heard about that recently since there's been a lot of talk about it. I first thought about this concept. I heard Lance Roberts on the Wealthy On YouTube channel, which I highly recommend. And Lance pointed out that these brokerage firms really want to attract and keep as clients the $50 million clients, not the $500,000 or the $100,000 clients. Of course, they want them as well, but they really have to have some sort of protection for the ultra wealthy, for them to be able to keep their money there. So that really stuck in my mind, and I started thinking about it more. Now, I had checked on excess insurance coverage back after the 2008 financial crisis, and it's funny how these cycles happen and everyone gets really concerned about these things when there's a banking blow up, and then everybody sort of puts it on the side burner, sort of forgets about it and gets really comfortable again. So this isn't the first time I've dug into this, but Lance triggered my memory around the excess SIPC coverage. And what this is most firms do in fact have that excess coverage so that they can keep those very, very high net worth clients. Now, the excess SIPC coverage varies by the broker, and I did a little research on this. So let me show you what I found at Schwab. And you can do this with any broker, although I will say it's a little bit hard to find the SIP excess insurance coverage at some of the brokerage firms. I had a really hard time finding it. I'll talk more about that in just a second. But I use Schwab, so I wanted to check them out, and it was very easy to find their coverage. I really like that. Now, there's been a lot of talk lately about Schwab and their insurance coverage, so that may be a reason why, but nevertheless, it was really, really easy to find. And you can see here that they have SIPC excess coverage insurance for securities and cash. And if we go down, we can see that the combined total of our SIPC coverage and our excess SIPC coverage means Schwab provides protection up to a combined return of $149.5 million per customer, up to $1.15 million of which may be cash. So there is a lot of excess coverage there at Schwab. And again, this varies depending on the brokerage firm. So you can go to your brokerage firm. I really encourage everyone to embrace their own investing, to take responsibility for their own investing. It's so easy and good to find things yourself these days. You can also just pick up the phone and call your broker if you're unsure. Now, having said that, I did say it was a little bit hard to find the excess SIPC insurance, which leads me to my next point that I want to share with you, and that is I want to thank Diamond Nest Egg YouTube channel for providing the following excess SIPC coverage limits on an excellent video that she did. She's got some great videos over there. The Fidelity, for example, has $1 billion of SIPC insurance coverage, so a little bit more than Schwab. And Vanguard only had $250 million. But on a per client limit, that came out to $49.5 million for lost securities and $1.9 million cash coverage. So you can see that there is a lot of coverage when we consider that excess SIPC insurance. Now, who exactly is the SIPC? A lot of people think they're a government agency. I want to share with you what I found in doing a little research on who exactly is the SIPC and Could they default? I mean, who covers them? So that was what I was sort of trying to dig into, and to be honest, I couldn't find any really great information about that. What I did find was from Investopedia, and I want to read that to you. The SIP fund was established with the corporation to cover its expenditures. The fund comes from members and interest from U.S. government securities that the SIPC purchased. And here's the next part that was sort of interesting. The corporation also maintains a 2.5 billion line of credit with the U.S. Treasury. So we'll just make an assumption that they're doing a better job in managing their risk from the U.S. Treasury bonds with the interest rate fluctuation, those fluctuations that come from the U.S. Treasury bonds when those interest rates fluctuate like they do, which has led to much of the problem in the banking sector recently. As an individual investor myself, my question was, well, what if something does happen and I am at a loss? How long would it take to actually get my money back? That was really a question, because we want to have things structured where we can keep operating if something like this does happen, if there is some sort of financial crisis. And I feel like I will get my money back should some sort of blow up happen, but I also don't want to be without money in the event that something happens. So my question was, how long does it take to get the SIPC to pay out? And what I found was on the SIPC website, and it says that in some instances, and I'll read it exactly, a trustee may be able to transfer funds in as little as 1 to 3 weeks. 3 weeks is kind of a long time. However, if the records of the defunct brokerage firm are in disarray, or if for any reason it is not possible to transfer your account to a financially healthy brokerage firm, that sounds kind of scary, the process may take more time. Remember, the FIDC is what covers bank accounts, while the SIPC is what covers your assets at a brokerage account. And I think the important thing to remember is that this is more about if your securities go missing or something happens to cash at your broker, as opposed to some sort of loss because it was a bad investment. The other important thing to remember is that in the event of some sort of default at a broker or some sort of terrible failure, then the assets that you own are still intact. They are the assets that you own. So the first action that will happen is those assets, whether it's a stock or a bond, will be transferred to another brokerage firm. Now, I don't really think of CDs so much at brokerage accounts as I think of stocks and bonds, but I did see that CDs are on the list of coverage. Most of us have stocks, so those stocks would be transferred to another brokerage account. And so that's the main thing, I think, to the way to look at this as we look at the SIPC and how our coverage is for our broker. So these are the main points to consider if you're concerned about the insurance on your brokerage account.